Sampling is a fundamental statistical technique used in management accounting, auditing, market research, quality control, and business analytics to obtain information about a population by examining only a representative subset of its members. Since collecting information from every item within a population is often impractical, costly, or impossible, sampling provides an efficient method of obtaining reliable information while reducing time, cost, and operational disruption. Effective sampling enables management accountants to make informed decisions regarding budgeting, forecasting, performance evaluation, inventory control, and strategic planning using limited but representative data. The population refers to the complete set of items, transactions, or observations under investigation, while a sample is a subset selected from that population for detailed examination. The validity of sampling depends upon two essential principles. The sample must be sufficiently large to produce reliable conclusions, and it must accurately represent the characteristics of the population. Failure to satisfy these conditions may introduce sampling bias and reduce the reliability of managerial decisions based on the sample results. Sampling is particularly valuable where populations are extremely large, continuously changing, or where testing every item would be excessively expensive or destructive. One of the most widely used techniques is simple random sampling, in which every member of the population has an equal probability of selection. Random selection minimizes personal bias and provides statistically valid results suitable for inferential analysis. Random sampling is commonly applied in auditing invoice transactions, customer surveys, quality inspections, and inventory verification. Because selection is entirely random, the sample is likely to reflect the characteristics of the overall population, provided that the sample size is sufficiently large. However, random sampling may become impractical when populations are extremely large or difficult to identify completely. Systematic sampling selects observations at fixed intervals from an ordered population after choosing a random starting point. For example, if a population contains 50,000 invoices and a sample of 500 is required, every 100th invoice may be selected following a randomly chosen initial observation. Systematic sampling is easy to administer and ensures that observations are distributed evenly throughout the population. Nevertheless, if hidden patterns coincide with a sampling interval, systematic bias may occur, reducing representativeness. Consequently, systematic sampling is most appropriate where population ordering is random rather than cyclical. Stratified sampling divides the population into homogeneous subgroups, known as strata, based on relevant characteristics, such as geographical region, income level, customer category, or production department. Random samples are then selected independently from each stratum, usually in proportion to its size within the population. This method improves representativeness by ensuring that all significant groups are included and often produces more accurate estimates than simple random sampling. Stratified sampling is particularly useful when populations are heterogeneous and management wishes to compare performance across different categories or segments. Cluster sampling differs from stratified sampling by dividing the population into naturally occurring groups or clusters, such as retail stores, factories, schools, or geographical regions. Rather than selecting individuals from every cluster, a random selection of entire clusters is chosen, and observations are collected from those selected groups. Cluster sampling reduces travel and administrative costs when populations are geographically dispersed, although sampling error may increase if clusters differ significantly from one another. It is widely applied in national surveys, regional market research, and large-scale operational studies. Multistage sampling extends the cluster approach by selecting samples through successive stages. For example, a nationwide customer satisfaction survey may first select regions, then cities within those regions, followed by stores within cities, and finally customers within stores. Multistage sampling provides considerable flexibility and reduces data collection costs, while enabling very large populations to be investigated efficiently. The technique is commonly employed in government statistics, demographic surveys, and multinational business research, where direct sampling of individuals would be prohibitively expensive. Unlike probability-based methods, quota sampling is a non-random sampling technique in which researchers select observations until predetermined quotas for particular characteristics are achieved. For example, a market survey may require equal numbers of male and female respondents or specified proportions of different age groups. Interviewers choose participants conveniently until each quota is satisfied. Quota sampling is inexpensive and quick to administer, making it popular in commercial market research and opinion polling. However, because individual selection is not random, interviewer bias may influence the results, reducing statistical reliability and limiting the ability to generalize findings. Selecting the most appropriate sampling technique depends upon the objectives of the investigation, the nature of the population, available resources, and required statistical accuracy. Random sampling is preferred when unbiased statistical inference is required and a complete sampling frame exists. Systematic sampling is suitable for sequential records, such as invoices or payroll data. Stratified sampling is appropriate where distinct subgroups require proportional representation, such as analyzing customer segments or employee categories. Cluster and multistage sampling are advantageous for geographically dispersed populations where data collection costs must be minimized. Quota sampling is most appropriate for rapid market research, where speed and cost efficiency are more important than statistical precision. Consequently, understanding sampling techniques enables management accountants to collect representative information efficiently, support reliable forecasting and budgeting, improve decision-making, and enhance organizational performance while controlling the costs associated with large-scale data collection.